So just want to say good morning to everybody and welcome to tutorial for week 5 of Chinese equity market with Paul McGuinness. And I'll be recording the session today. So I don't do that every time, as you have realized, but I do it. I do it when I think in my judgment the material may be a little bit hard to follow, or if you lose me, you lose your track halfway through, then at least when you get home you can review it. Okay. So like I've said many times, if you're listening to me and suddenly you lose me, then just note down the time on the top right hand corner, and then when you go home, that point when you fast forward your video, that will be exactly the point where you got lost. Okay, so what I want to do this morning is I was going to talk about bonus issues and scrip dividends and stock splits. I think I will leave that until next time because Paul hasn't completely covered this topic yet. And a second reason is he would like me to run down with you the first assignment, the solutions, to make sure everyone is okay. Your final exam is quite likely to be in a similar format, although I think it'll be more difficult. I also will pick up a number of questions that you have sent me, thank you very much, over the last couple of weeks, and I'll try to answer them, okay? But let me, okay, so by way of logistics, so as I said, this is the timetable, and where you see some dates appear as sort of hyperlinks, like this one and this one and this one, that means when you click on that, it will take you automatically to a YouTube video. You click on that. So some sessions are recorded, some are not. So this was last week, and for this week, so right now we are here. So this session is being recorded. Okay. Now, by way of housekeeping, so next lecture obviously is this afternoon. Venue is downstairs, I think. Assignment number 2 that you have been given actually will be due at the start of the lecture. Now, last week I wrote down October XX because I had no idea when Paul wanted you to hand it in. But actually this is correct. Why is this correct? He wants you to hand it in on October 20. XX is 20 in Roman numerals. Okay? So that's a coincidence. But anyway, so it is due in 1 week's time, please, everyone. And you have to hand it in at the start of the lecture, as you know very well by now. Okay? And we need to get everybody to submit their work at the start. Now, let me, not going to talk about this right away, but we will. I want to go to the assignment, your take-home assignment number 1. And take a look at that. Now, I think the the true-false questions mostly are pretty simple. I looked at all of them, and I have not received any questions from you guys. But there were a couple. I want to have a look at number 19, for example. So it says, for an H-share IPO in Hong Kong, an over-allocation of shares requires the global coordinator or the IBank to borrow shares from the pre-listing controller. This is false. Now, somebody was asking me why, how do I make sense of this answer? The logic is this. It is true that, as we have said before, so when you have just an ordinary, normal, simple IPO, never mind the H shares, just a normal IPO. Let's say the company was always in Hong Kong, incorporated in Hong Kong, and then so think of something like Giordano or something like that. Okay, so not H shares. So it is true that initially the shareholder structure would look like this, and now the IPO will sell a part of that equity. And so, like I said, in terms of execution, when you need to over allocate, so what are you actually doing? What you're doing is, so if this is the IBank, I'm using the term IBank and global coordinator intermittently. Global coordinator is too long, okay? Or GC. So here is the issuer. And let's say the issuer is selling 1,000 shares, or at least that's what they say in the prospectus. Now, you know very well when you're out there, you are going to over allocate. If this is the market, so you may sell 300 to, big client, and then the other ones. So your target is to over allocate on purpose an additional 15%. So these guys down here, whoever they are, will end up getting 850. Now you don't have enough. We talked about that. You don't have enough. You have 1,000 coming in and 300 going out, 850 going out. So your settlement will actually fail on the first day, unless you do something about that. So what do you do? Well, like we said, there are two things you can do. If this is a cornerstone investor, so you borrow 150. So at least now it will actually settle, okay? Because the numbers now add up. You got 1,000 going in, you got 1150 going in now, and you got 1150 going out. But those borrowed shares eventually have to be repaid. They have to come from somewhere. Okay, now that's one way. The other way is indeed you can borrow from the issuer. Okay. So you can do that too. So that's what I keep saying. Please distinguish a major concept from a minor detail. This to me is a minor detail, okay? Green shoe or over allocation is a major concept. How you do that, in my mind, is a minor detail, but you can do it either way. And if you want to get an understanding of that, wonderful. But for me, it is of, kind of secondary importance. You know what I'm saying? Yeah. Now, it is true you can do that. So people are wondering, they look at this question, why is this false? Why don't you borrow shares from the controller? Or, very good, very good. It's actually now the problem with an H share IPO, the fact that it is an IPO, initial public offering, means there never were any H shares to lend. Okay, so this IPO is a little bit different from the one I just described to you, which is an ordinary, good old fashioned, boring Hong Kong company. But so you can do that for a Hong Kong company, Hong Kong company. But if you got something which originated from China, now that is a little bit different. Why is it different? It is different because the shares that were there, they never were tradable in Hong Kong. There never were any H shares. They might all be A shares, okay? Or they may be, sometimes non-tradable tradable or non-tradable format. And then some of these are converted for IPO purposes. So these are now converted for IPO. So let's say you literally just convert 1,000 to begin with, okay? So now there is no more H shares. This is all we have at the beginning, not a single share more. So you can't borrow from these guys. They don't have H shares to lend to you. You see the difference? Yeah? Because you didn't start with, and Jackie's right what he said, you never started with fungible shares, lendable, fungible. Now these might be lendable, I don't know if they are, but even if they are lendable, they're no use to you because it's actually a different share class. Is that okay? Is it okay? Carmen? No? You were the one who raised this. So do you understand why you can, these shares are all the same, all of them. I'm talking like just a Hong Kong company, okay? Do not think of Chinese companies, just an ordinary company that you start in Hong Kong, something like Hutchison or Cheung Kong or Sun Hung Kai, where all the shares are actually the same, okay? Now the IPO process, you're okay with that, yeah? So here you actually can, the majority shareholder can lend. So it's like taking some shares temporarily from this box and lending it to this pool, and then just to wait for 3 weeks to see what happens. You are okay with that, yeah? That's for a Hong Kong company, and people do that, okay? The reason, okay, the key to it is you take some shares from here and you lend it to this IPO pool, okay? Now, the reason you can't take from this pool and lend it into here is that these are actually A shares. And this pool is designated as a H shares pool. So you can't lend to them because the shares are different. This is what the controller has, okay? The majority shareholders. So these shares are, in China, and they are of a different form. So lending them would not be useful. You understand? Sure. Okay. Now, so that was, I think that's one of the questions that people raise. Is everyone okay with that? Sometimes there's more to it than you think. Um, Another one I want to just take a quick look at is 38. Okay, now a reverse stock split is also known as a capital reduction. Is that true? A reverse stock split is not known as a capital reduction. Okay. Um, what is another corporate equity restructure that is known as a corporate reduction? A capital reduction. It is an exercise called share buyback. Okay. Now we'll talk about that in the coming weeks. It is a fascinating topic, and it is happening. It's been happening now for a couple of years with many companies, which I will share some examples with you. But capital reduction is the another technical name for share buyback. So essentially, what you do, and Paul will talk about this. So you are a company, and they have. So this is a company which is already up and running, and already the shares are listed. But they have some on the asset side. They have cash. They are cash rich. So they use some of this cash to actually buy back the shares from the shareholders. So the cash is gone, okay, and some of the shares are gone. That's known as share buyback, otherwise known as capital reduction. Okay, so try and remember that. Now, let me go through these, and because the solution's already there, I want to focus more on some of the questions where either the answers are not so obvious, or when I feel there's something useful I can say, or there are some questions where they just give the answer like a number, like here, for example. Okay, so I'll try to talk a bit more on those. Okay, and what I think I will do is after we go through, and I think we may not have time to go through the whole thing today, but it's okay. We can continue. But I will upload a copy of this with all my scribbles, all my writing. If it doesn't help you, then don't look at it. But if you think it does, then you can download it. Okay. Now there's a first question here. You have an IPO in Hong Kong. This is actually a Hong Kong, supposed to be a Hong Kong-based entity. So Hong Kong Incorporated Company, RETHK, and there are 1,200 new shares and 600 old shares. So the total offer is 1,800. Okay, so they tell you that. Now, if there were already 5,600 shares prior to the IPO, so this 600 must have come from that 5,600, and of which the founding investor, HKTYC, holds 80%. So 80% of 5,600. And there's another European VC fund which holds 20%. And so these two investors will sell each of the 600 shares. Is going to be split into 480 and 120 because it's 80%, 20%. Okay, so these are the shares they are going to offer. In addition, the overall IPO is subject to a 15% over allotment feature. Okay, now this is where even just 1 or 2 weeks ago people got confused. I think another way to put this will be to say, in addition, the overall IPO is subject to a 15% initial over allocation. Okay, so they're planning to do that. The over allotment feature, or the green shoe, that may or may not happen. Okay. Now, what percentage of RETHK's voting rights will the major shareholder retain after the IPO and subsequent full green shoe exercise? So you assume the green shoe was completely exercised, okay? Okay, so first of all, a question like this, you only have two things to worry about. The first thing is for the controller, how many shares will they be losing? Well, how many shares did they have to start with? Okay, now 4,480 is just 80%. This is 80% of 5,600. Okay, so that's what they had to begin with. Now they are going to lose, or they plan to sell 480, but it doesn't stop there. They will sell some more from their own holdings. They are going to sell another 15%. So that, and this is assuming that the full green shoe will be exercised. So they will be selling total this amount. Okay, so the shares of HKTYC will go down by this amount. Is everyone okay with that? Yeah? Now, the second thing you need to think about is how many shares, how many new shares have come into existence, because that's the only thing that matters, okay? Do not make the mistake of including this number into the bottom part, okay? The bottom part is the old shares that were in existence plus the new shares, which come from here, and then the over allocation of the new shares, which will be issued because the green shoe will be fully exercised. They tell you that, okay? So it's always, questions like this, it's always like that. Work out the top, work out the bottom. If you get both of them right, your answer has to be correct. So the amount comes to 56.28%. Is everyone okay with this? Please raise your hand if you're not, okay? I really prefer to, if someone doesn't understand, I prefer to share the query with the entire class. You know that, okay? So put up your hand if something you don't understand, okay? Yeah, in fact, another tip for you is when you do pose questions, sometimes when there's small print, you have to read the small print, and you have to read the small print quite carefully they can offer some clues to your question. And the clue it's offering here is that there will be an additional 72 million shares offered by HKTYC. Okay. And that actually appears right here. Okay, so and the 180, in fact, they practically gave away the answer. So in terms of balance sheets, I strongly recommend when you are doing these questions, either as assignments or when you are in the exam, keep drawing these balance sheet diagrams. That's how I think. Okay, otherwise I get confused myself. Okay, so this was the old shares, 5,600. So that's not going to go up. Okay, but there are some more new ones, 1,200. But wait, it doesn't stop there. Another lot coming, 1,800. Fine. Okay, so I know the total. So if I'm that big shareholder, how much have I lost? Well, I'm going to sell 480 to begin with, so I'm losing that part. But no, not only that, I'm going to lose some more. I'm going to lose another 72. So you are going to be dividing this one, if you call that X, by this one, aren't you? So it's just X over Y. It really is that simple. Once you draw the diagram, right? You just have to be systematic about these things. Okay? Is everyone okay? Yeah? All right. Now, let me move to the next one. So, given a final offer price of $5 per share, how much gross funding before the fees and other stuff is generated? Well, that's simple. These are new gross funding proceeds. Okay, when people say gross funding proceeds, it means new money, and the new money can only come from new shares. Okay, if you made the mistake of including the existing major shareholders, then your answer will be wrong. Right? You catch what I'm saying? So that's the important point about this question. So the gross funding proceeds are the share price multiplied by new shares. That's why I say new funds. Okay, if you only sell shares from the existing shareholders, like in the Prada case, if you only do that, what will be your gross funding proceeds? Do you understand my question? If in another case, when you do an IPO, okay, you are only selling shares from existing controlling shareholders. If you do that and you don't have new shares, thank you, Jackie. Okay, yeah. You catch what I'm saying? Is it too early in the morning? Have you had a coffee yet? Okay, get one after this. Okay. Yeah. So just be careful of that. Okay. I'm betting. I haven't seen your answers, but I'm betting some of you made that mistake. Am I right? Thinking that the gross funding is the share price multiplied by all the shares that are sold. No. Oh no, maybe you didn't make the mistake because it's okay. No, I take that back because it's actually split up. Right? Okay, I take that back. So yeah, then yeah, but you know what? If part 2 and part 3 were not there, and if we just look at this company, I think some people might make that mistake. But now it's difficult. Okay. And All right, so so this is the over allocation by on purpose, and so note that 72 is simply 15% of 480 and so on. Okay, so this should be quite simple, and this should be quite simple. Now, in relation to all the above, calculate RETHK's market cap at the close of the 20th day of secondary market trading if the share price was $6. Now, how hard is that? All you need to do is to be very, very clear just exactly how many shares there are now in the company. And if you got this part right, then you can't get it wrong, because you are recycling that number. You are using it. So the number of shares is 7,600 multiplied by $8. Okay? Everyone is okay? Always be very clear what is the total number of shares in the company before and after an IPO. If you get that right, you have a good chance of getting a lot of things right. You get that wrong, everything is wrong. Okay? Still on. Okay. In relation to question 41, compute. Now, this is an interesting one. So, compute the price to book of this company based on the net asset position after greenshoe exercise. Okay. Accordingly, compute the book value just prior to the IPO. Okay, so what they're doing is they have given you the PB ratio, price to book, after the IPO and after full greenshoe exercise, based on a share price of $5. Now, I think first at this point, it is instructive just to explain a little bit what the price to book actually is. Does anyone know what is the meaning? So some accounting experts here maybe can help me. What is your understanding of the price to book ratio? Anyone? Anybody else? So who knows what price to book? Who knows what price to book? What? That is correct. So what is book value? Yeah. Again, it's correct what you just said, but I like to try and visualize these things. Now, when you have a balance sheet, so you have assets over here, X, and you have liabilities, Y, okay? And you have Z. Now, the price to book ratio of a company is when you take X and you take away the Y bit and you divide it by Z. Now, I know immediately you're gonna say, hold on, Sam, shouldn't that just be equal to 1? Because X minus Y is Z. Well, yes, in theory, it should be equal to 1, okay? Now, in practice, it isn't. It isn't, I think, for a number of reasons. So things are never so simple, just X, Y, Z like that. In a company, some assets are not marked to market properly, or there is appreciation, depreciation. There is on the liability side, again, things may not be valued at market. The Xiaomi case was a prime example of that. Plus, you have things like patents and goodwill and brand recognition, which are not really what we call tangible assets that you can touch. For all those reasons, the price to book is seldom at exactly 1, okay? And but we don't need to be concerned with that. The thing is, if you look at the question carefully, okay, they have given you the price to book after the IPO, all right? Now, what's the best way to do this? So after the IPO, right at that moment in time, you are going to get some cash. And let me call this X1, and let me call this X2. Okay, and I'm going to call this EZ1, and I'm going to call this EZ2. Okay, so and then right after the IPO, you just get cash. So things are a little bit simpler, but if it was sometime after, then things will change again. Okay, so what they are telling you is that shortly after the IPO, so you have X2 minus Y divided by hold on a second, Z2 is equal to 2. Okay, is everyone okay with that? Let me flash up the question. Okay, so the PB ratio based on a company's assets after the green shoe is 2 times. Okay, and they want you to compute the value, the book value of the assets just before the IPO. So that means they actually want to know what X1 minus Y is. That's what you need to find out, okay? So they want to find out what this bit is worth. Okay? Now, the way you do that is if you know this and if you know this, you should be able to work out what this is. And you look at the question and that's what they've done. So 2 times is equal to what? Is equal to 41880. Well, now where does that come from? Thank you. That is the market cap. That actually came from just immediately above, okay? So the total worth of the company divided by, now what's BVNA? Now this is actually the book value before. This is what you want to find out, okay? The book value before plus the new cash injection that has come in, okay? So I put here new cash. If you didn't know what was the book value before, you just put it there. That's what you're trying to solve for. But you know that the book value before plus, in other words, you try to solve for this. You don't know what it is, but you know that this part, okay, is, how to say, the market value is 2 times this one, okay? From here to here, here to here, okay? And then you just solve for it like this. Now the new money that's coming is this one. So 1,380 shares times 5. However, now once again, please read the small print. There is an adjustment factor here. Where does that come from? That is, if you read this part, they have taken out some fees, which is 5% of the new cash. Okay, so therefore, if you take that into account, the amount of money that has come in is this, but some fees have gone out immediately, 5%. So how much is that? 1,380 multiplied by 5. And 5% of, actually it's 345 million. I worked that out last time. Okay, so those fees have gone out the door. And then you just solve for it. One equation, one unknown. And the book value before is 14,385. Is that okay with everyone? Yeah? So the trick to this question is, number one, step one, what is the market cap? Well, step one is how do you set up the equation? You know, so you put 2 on one side. 2 is equal to the actual market cap divided by the old book value, which you are trying to figure out, plus the cash that has come in. So that together will make a new book value, except that you're going to take 5% off that. Okay? Everyone is okay? Yeah? That's good. If not, look at the clock and then go home and just go to that part. Okay. Okay, now suppose RETHK's PE ratio at the point of the IPO, and thus before greenshoe, is 10 times the PE ratio. Note that this ratio is based on the final offer price of $5 per share and the pro forma fully diluted number of shares. Accordingly, compute net profit at the end. Okay, now this question, the key to it is before the greenshoe shares are taken into consideration. Okay, so you really you are only adding 5,600 to 1,200. So forget about the 180 here for this question anyway. Okay, so 6,800 shares, and the net profit, which you don't know, or earnings. Okay, but you do know that it's selling at if it's sold at $5 per share, the PE is 10 times. So you just solve for that, and the net profit is 3,400. Okay. You see, a lot of these footnotes and little comments, they provide you the best clues. So this figure is testing whether you understand pro forma fully diluted. Before greenshoe, okay? After IPO, before greenshoe. All right, so they make that quite clear. Okay, I'm gonna go through a couple more. Now, I stopped the last tutorial at this point, so I think I will do the same here, okay? And we pick up from here next time. Actually, the rest of it, some of it is not really that hard. There's a lot of fact finding I noticed, so I will not go through the fact finding questions, but next time I'll go through the numbers. But let me just continue, and after we get here, after we finish this part, I will answer some questions that I received over the last week. Okay. So in accordance with the split share reform program in China, suppose the controlling investor ST Reg wants to convert its non-tradable, so it's unlisted and domestic stock holdings of 2.52 billion shares into tradable A form. And actually, ST Reg, I thought it's the name of the company, but no, it's actually the name of the major investor. The company name is CEM Tut. Okay, so that is the company. So suppose that just prior to the announcement, CEM Tut had 4.2 billion shares, of which 2.52 are held by this person, ST Reg. Okay. So the share structure, which you can see is reconfirmed here. The share structure is there are 840 tradable H shares, 840 tradable A shares. This is actually an existing structure. Okay. So this is not an IPO question. This is already here. And when you add them all up, you add these up, they do actually come to 4.2 billion. They do. Okay. This question, the details are kind of a little bit back and forth. So they talk about the major shareholder, then they talk about the company, they talk about the shareholdings of the major shareholder, and then the total shares of the company, and then the breakdown. Okay. So the information goes back and forth. Okay. Now, so CEM Tut also has an ADR program with ADS shares, ADS listed in New York. To gain support from the split share proposal, they will compensate existing tradable A shareholders with 2.9 shares, 2.9 A shares for every 10 that they currently have. But the H shareholders do not get that. Okay. Compute the following: the number of tradable A shares outstanding after the split share reform program. Okay. Now, before there were 840 A shares, and for every 10 shares, there will be an increase of 2.9 shares. So you multiply by 1.29. Okay, now this actually, at first when I read this question, I wasn't entirely clear, but it looks like it is quite generous. This is not a bonus share as such. This really is giving away part of the ownership, from what I can gather reading this question. So ST Reg, being a state entity, really is giving away part of its ownership from its own equity base to the A share people. Okay, now what is the difference? If you remember, if you recall, just last week or a couple of weeks ago, when we were looking at this document, the stock reorganization, okay, we talked about bonus issue this doesn't look to me like a bonus issue. I mean, you're welcome to confirm it with Paul McGuinness, but okay, first of all, what is a bonus issue? A bonus issue, you have to look at it in a different way, okay? Now, in that, I run the risk of confusing you, but I think I really should point it out. This is now the 50-minute, 50. Okay, so if what I'm about to say doesn't make sense to you, go home and review it, okay? Now, about the bonus issue as described here, the bonus issue is, and that case was described in, from an accounting viewpoint. So you have shareholders, and it's looking at it from the point of view of, paid in capital, and then there's a share premium account. You do remember we spoke about that, right? Now, the first thing to remember is all of that belongs to all the shareholders. This belongs to everyone. And the so-called bonus issue is nothing more than issuing some shares and then turning that into paid in capital. So it really is like taking money from one pocket and putting it into another one. So if you are a shareholder, from an economic point of view, this kind of bonus issue should not actually increase your wealth, okay? It is just simply increasing the number of shares, and whatever you get, the new shares, the value of that, it used to belong to you. Okay, so the value of the company doesn't change. Now, this case, I think, is actually a little, not this case. This case is a little bit different if you read it carefully. So here, we are not looking at it from the point of view of this account, that account, paid in capital, share. We are not looking at it from that point of view. We are looking at it really from the point of view of share classes. Thank you. Okay, so there is a share class H. There's share class A. So H just gets what belongs to H, which is this part. A gets what belongs to A, which is this part. And then there's the non-tradable. And then it seems like this guy here, what's the name? ST Reg is the owner. Really is giving away part of its holding to the A guys. Now that is actually very, very different from, so here, if you are an A shareholder, your wealth will increase because it's a gift. It's a gift that previously did not belong to you. It belonged to somebody else. Okay, so it's carving this out and say, okay, I'm going to give up this. Okay, here you go. Okay, that is my reading of the question. But that's not really the case on the left-hand side. Is everyone okay with me on that point? Yeah? So you got to be careful from what point of view you are looking at. In this case, it's just, which letterbox. You take from one letterbox, you put it into another letterbox. But from the point of view of all the company shareholders, nothing has changed. Their wealth would not go up. But here, if you look at, now it's segregated into H and A, and then non-tradable. If you are going to reallocate from non-tradable to A, if you do that free of charge, well, the A shareholders, their wealth will increase. You see the difference? It's quite subtle. Okay, so make sure you're okay. So I've now talked for 5 minutes, from 50 to 55. Okay, so go home and listen to that part if you need to. Okay. All right. Let me. Is everyone okay? Everyone is happy? All right, that's good. You know, if one day you want to be, if you want to be a, what are they called? FC. You know what an FC is? Thank you. Financial controller. Now, you see these terms, this confuses the hell out of everyone. Financial controller in a company is not the majority shareholder. Financial controller is another word for chief financial officer. Okay? It's another word for treasurer. That's a more old-fashioned way of, okay? So this guy is actually an employee. I think this is a more accurate term because you are an officer, not CEO, CFO, Chief Financial Officer. You are an officer. If one day you guys want to work for, what are they called? Conglomerates, you know, big financial corporations in the Treasury Department, is what it's sometimes called. A treasurer works in Treasury, not U.S. Treasury, but still it's a Treasury. If you have that kind of ambition, these discussions will be very, very helpful for it because that's what you're going to be thinking all day. Okay? All right? All right, now, so that's pretty heavy stuff. Let me now go to my favorite part. And I'm not gonna, I'll do this next time. I actually prepare some interesting stuff I'll share with you next time. But I want to grab a couple of questions, okay? So this is one of them. Dear Sam, I cannot fully understand the idea of waiver in Hong Kong IPO. Will you please tell us some rules and applications? That's one of them. The other one, dear Sam, what is the difference? Sorry, what is the difference between a transaction contract and a transaction order? Teresa, this is, I'm kind of turning your inquiry into a question. So I'm trying to address that, okay? Now, it's a good one. What is the difference between a transaction contract and a transaction order? By the way, maybe one thing I didn't make so clear before is that just in terms of terminology, okay? So in an IPO, you have the, you know, the corporate customer, the issuer, and then you have the iBank, and then you know you have two markets, two major segments. There's the retail, and then there's the institutional, sometimes called the international. But institution can be a local institution, okay? Sometimes called a placing tranche. Now here, to be precise, is, you know, it's subscription based. So you fill in a form, you sit in front of some broker at a bank or stock brokerage, you fill in a form and they submit that form. You tell them how many you want to buy. Maybe you want to buy 1,000, in which case they might persuade you to subscribe for 10,000. We spoke about that, okay? You don't know the price. You don't know the price. You know the price range. There is a range, and it'll be in that range, okay? Now that's retail. Institutional is when you are allowed to say, all right, let's say that the price range is from 10 to 12. So customer A might say, I'm happy to buy at $10, I'll buy 3 million shares. And if the IPO was set at $11 I'm happy to buy I may not get it. I'm happy to buy 2 million shares. And B might say, okay, at a price of 11.50, I'm happy to buy 2.5 million shares, and so on. Okay. Now, first of all, what is the name of this exercise? It's called book building. Okay, book building. What book are you building? You are building an order book. But the word order does not appear. Okay, so no one ever says order book building, but that is what you are doing. This is an order book. So C comes in. C is really aggressive. All right, I'm going to pay full on $12. I want 4 million shares. Okay, so now you have 3 orders. So D comes in. D says, well, yeah, I'm not sure about that. Maybe $10 and 500,000 shares, and so on. Okay, now these are orders, which leads me back to this question. These are orders. What is the difference between an order and a contract? Now, let me talk about the contract first, okay? If you have a contract, and these are not contracts, so don't look at it. What is a contract? A contract is when two parties, A and B, okay, they agree to exchange something, and this happens a million times a day. You agree you're going to buy an apartment in 2 months. In 2 months, you pay $10 million and you get your apartment. Now, this transaction, it must happen. It must happen. And if either party doesn't show up, the other party can actually call the lawyer and sue you, okay? Because that is actually technically, it's a breach of contract, basically. A contract means two parties agree at some future point to exchange something for something. Okay? Is that okay with everyone? If in the future, if I promise you, okay, in 2 months' time, I give this to you, my mobile phone, and I don't charge you anything, okay? That, ladies and gentlemen, is not a contract. That is not a contract. But if I give this to you in 2 months and then you pay me $1 and I'm okay with that, okay? I'll be out of my head, but I'm okay with that. That is a contract, okay? So it has to be an exchange of something for something. If I say, okay, you can have it in 2 months, and then I broke my promise, you say, oh, you broke your contract. No, I didn't. We didn't have a contract. Now, an order is like this. So if you look at the examples above, so let's take D. So D wants to buy, or D is happy to buy, or prepared to buy 500,000 shares at $10. Okay, so D says, all right, I'll buy at $10. I'll buy 500,000 shares. So that is 500,000 shares. Okay, so they tell that to the iBank. Now, up until the time when the IPO price is determined, okay, until that point, or might be a little shortly before, I don't know the exact timing, but D actually is allowed to change their mind. Okay, so if the IPO is happening 1 week from now, suddenly say, no, I don't want to do this, you can. You just walk away from it. Okay? An order is different. Now, so let's say it is now on the IPO day, and the IPO price has already been announced, and the IPO price is set at $10. So the iBank actually is able to allocate this amount of shares for this price. Now it becomes a contract. Okay, so an order, if you like, an order is a kind of conditional contract. So it's not a contract yet, and you are free, you are allowed to cancel until the condition is actually fulfilled. Are you with me? I'll make a simpler example. Take the stock market. Okay, take let's say the shares of Microsoft. Now, where is Microsoft trading right now? Let's try and find out. Okay, so right now, well, not right now, because now it's not trading, but let's say it is. So Microsoft shares are $109.57. Okay, imagine that is the market. Now, you can actually leave an order to your broker. You say, buy 10,000 Microsoft shares at 109. Can you do that now? You can't, because the Microsoft shares are not that cheap. Okay, you want to buy cheap, but who knows? It goes up and down. It may actually get there. Okay, now the moment it gets there, the moment it gets to 109, and the order is executed, you can't change your mind anymore. Okay, but at any moment in time before that, you can actually change your mind. You see the difference? Yeah. So an order is not a contract until the condition that you specify is actually fulfilled. At that point, you can't back away. What condition? This is the condition. Okay? So in other words, all those over allocation and this and that is for the purpose of building a book. It's for the purpose of building the order book. And those orders that you place, they can actually be cancelled. Okay? So I hope that's clear. Now, let me talk about this one. I cannot fully understand the idea of waiver in Hong Kong IPO. Would you please tell us some rules and applications of waiver in the next CEM tutorial? I think this isn't so much rules, but breaking the rules. Okay, so what are the rules? Okay, the rules are, the rule is this. The rule is, let me talk in percentage terms, first of all. Okay, so you have a private company, and you are looking to do an IPO. Now, it could be that you currently have 1,000 shares, okay? The rule in Hong Kong is you have to offer at least 25% of these shares in an IPO. So that's 250 shares, correct? You have to offer this for sale. This is called the public float. So we need to know at any time what is actually, now the public float means it's available for liquid trading in the stock market. and then the other 75% are basically still held in private hands. You do know this regulation, right? Okay, now the waiver is sometimes some companies will go to the regulator and say, hey, do you mind, we don't do this, so this is the total number of shares, but I don't offer 25%, but I only offer 15%. So the other part will still not be in the public float. And then the regulator will say, yeah, why? Why are you doing that? Okay. And the company might say, well, look, you know, we are a really big company. Okay. We are a big, let's say our IPO is $20 billion. $20 billion. Okay. So 15%. Oh no, okay, I'll correct myself. Let's say the company is worth $20 billion, okay? So this part is 20 billion. So 15% of that means this part will be $3 billion. Now, in terms of percentage, it is only 15% of the entire ownership. 15%, but in terms of dollars, it is a big amount of money. That is the argument that is used by some of these companies when they apply for waiver. Now, if they want to have a lower public float, they can have whatever private reason, okay? But the reason, there can be 1,000 reasons. Reason is not important. The reason is, you know, what is their justification for it? The justification usually is we are a big company. If you are a really small company, let's say your total size is only 1 billion, and if you only have a 15% float, that means the amount of shares trading out there would be just $150 million. And then the regulator is likely to say, well, sorry, that is just too little. Okay? Too little in terms of percentage. First of all, you are breaking the rule. And too little also in terms of dollar amount. You get the point? So they give you a waiver if you claim that you are a big company. Are you okay with an argument like that? Yeah. No, I'm making a number up. The moment you drop below 25, you are breaking the rule. So it could be 20, it could be 19 and 3/4, it could be 17.5, whatever. Okay. When you break the rule, you apply for a waiver. If they give you a waiver, that is normally the rationale because they think that your company is big enough so that in dollar terms, the value of your shares trading out there is still quite substantial. You get the point? Okay, yeah.
Normally, the retail change only accounts for like 10%. In labor, in this IPO, it only 5%. That means total 100. That case. So it should be like after IPO, the percentage.
Yeah. After the IPO, the final, after, as they say in English, after all the dust has settled, after the IPO, you know, the final public float available. By the way, public float does not mean retail. Public float means the shares that actually are are available for trading in the stock market. Okay, public float does not mean retail. Public float, if you do an IPO and you have 1,000 shares and you offer 30% for sale, okay, 30% for sale plus green shoe, 4.5, and if that was fully executed, your public float will be 34.5. Some of this will be institutional, some of this will be retail. That is not our concern. Our concern is this number. Okay? Jackie, I don't know if you had that confusion before. I wasn't referring just to the retail part. Public float means, in theory, if you have a lot of money in your wallet, you go to the market and buy everything. What is the maximum you can buy? It will be, the public float. Okay. Now, I asked you earlier, are you okay with this waiver idea or the logic behind it? I didn't get any opinions. I'll give you mine. Okay. What do you mean, these two things? 25. Yeah. You mean the waiver, is it just on the total public float, or does it apply sometimes to the retail specifically? Oh. The financial tests. It certainly can. Waiver is a very popular word. I am referring here to the idea of the waiver with regard specifically to the public float, the 25% requirement. So I'm talking, there are other waivers for other rules. Basically, when there's, what is a waiver? A waiver is, okay, never mind, yeah, I'll relax my requirements, okay? This is not the only place when that's done, but this is what I'm now referring to, okay? Now, I want to, so I'll let you go soon, but I was asking whether you guys are okay with this idea, okay? I have a bit of a concern, and I'll share with you what my concern is, okay? So the rationale is that when you have a really, really big company, then even if your public float falls below 15%, if the dollar amount that is available for trading is big enough, that seems to be okay. Now, I want to take issue with that idea, and I'll tell you why. So let's say there's a company and they put up, they do an IPO, and they offered 25% of the entire company for sale. Okay, now, so this one does not break the rule. This one follows the rule. Now, typically, in any market, there is a measure of how active this stock will trade, and that term is called ADTV. Have you ever heard of it? It's got nothing to do with television, okay? It's average daily trading volume. Now that varies from one stock to another, but let's say it is around 2.5%. Quite often what you see is that the ADTV is approximately 1/10 of the float. In other words, if there's 25% out there, then every day there will be buy, sell, buy, sell, buy, sell, which amounts to around 10% of the public float. Okay? Are you with me there? Now, let's say you are a majority shareholder and you own 7.5% of the company. Let's just say 7.5, okay? That means if you sell all your shares to the market, it's going to take the entire market 3 days roughly to digest. If everyone just buys the shares that you sell and no one else is selling, it will still take them 3 days, correct? Yeah? On this basis. Imagine the same situation, but now you don't have 25% free float. You only have 15% free float. Okay? Now, I said to you, normally, and the problem is this, so 10% of this will trade every day. So now the ADTV will likely be around 1.5% because it's 1/10 of whatever the public float is. And that's the important point. So in this case, if you were to sell all your shares, it's going to take you 5 days. It's going to take you longer. 5 days is a long time. If you want to sell in a hurry, you have to wait another 48 hours. I think 4.8 hours can be too long sometimes, okay? You catch my point? I'm just sharing with you what can sometimes happen, okay? Any comments from everybody? Did you all hear the question? No, it doesn't work like that. Good question, very good. So she's asking, so we have to have the requirement that 25% of the company is in free float. So let's say this part is in free float. So in free float, there are 250 shares, and these are in private hands. And if the company decided to do a buyback, let's say a 10% buyback, they will actually buy back 25 shares from these guys and 75 shares from these guys. So the ownership doesn't change. Okay, buyback doesn't mean, oh, I only buy back from the people in the public. Okay, the best example is Facebook that I can think of. Mark Zuckerberg, he's a private shareholder, or Ma Yun. Okay, so they have private shares. So when you do a buyback, you are not only buying back from the shareholders in the public flow. You buy it back from everybody. Everybody will get money. Are you with me? Yeah? Yeah, sometimes when I draw it like this, where did I draw it? When I draw it, I lost it now. Was it this one? when I draw it like this, when I draw the balance sheet like this, and then I do this, I might have confused you. I might have, but it's actually, if you do a buyback, you are giving money back to everyone. So it's more like you are doing this. But you can't cut a balance sheet like that. Okay? You know what I'm saying? Everyone gets some money. Have I answered your question? Yeah. There was somebody else, wasn't there? Yes. Yeah. Correct. Yeah. Yeah. They are basically, well, if you, like I said, if you have a lot of money and you want to buy up every single share that you possibly can by going through just a public stock market, okay, the public float would be the maximum that you can buy, okay. Everything else actually is still in the private controller's hands. Yeah. Sorry, say again. Yeah. Mm. No. No. Yeah. Yeah. I Okay. This is kind of a little bit beyond the scope, but I'm happy to tell you. Um, what happens is this, all right? So you have a company. So before it was totally private, and then you offer some for sale to the public. So now this is in a public float. Now the shares in the public float and the shares in the private hands, they are the same shares, but these are not for sale. Okay, not for sale. But you can sell them. You can sell them, and the process that you sell them is called a season offering, where there is another process. In other words, if you are a major shareholder, you do not just at any time go to the market, oh, I want to sell. Okay, there is a process to follow, and that process is called seasoned offering, which I think Paul McGinnis started talking about last time. Okay, you can sell it, of course you can. It's just that you have to follow some rules. You can't just call up your broker and say, "Oh, I'm Li Ka-shing. Oh, I'm Ma Yun. Okay, I'm going to sell 5 billion shares." No, you don't do that. Okay. Um, okay. Thank you for all the questions. I do appreciate it. I think I will stop here. And like I said, I'm going to make a record of this, and I will put it online. And I will put this file online. And when you click on the relevant dates, then this video will appear. Okay. Thanks, everyone. Now, if you haven't signed in, do stay behind for a couple of moments, and I'll give you a chance. Let me just save this video first.